yourself and your friends home safely.
Do the right thing.
Visit arrivealive.org to find out more. Arrive Alive. Drive sober.
You're watching Rogers TV.
And welcome to Money Matters with Shannon Jackson, the personal finance show focused on moving you forward financially. On today's show, the affordability crisis facing Canadians continues to leave many struggling financially, and many are falling behind on their monthly bill payments. That is among the key findings of the latest Equifax Canada Consumer Credit Trends Report. And joining me now to discuss the report in detail and, more importantly, offer some advice on how you can turn this around, we have Rebecca Oakes, Vice President of Advanced Analytics at Equifax Canada. Rebecca, welcome to Money Matters, and thank you for being here.
Thank you for having me.
Before we get into the results of your report, can you share with our viewers a little bit more about Equifax Canada and what your role is there?
Sure, absolutely. So Equifax is a credit bureau or a credit reference agency. And basically what that means is that we collect information from lenders. They kind of report to us information about individual trade lines, types of credit that they have on their portfolios. And we basically pull all that information together and collate it into what's known as a credit report. And that's something that lenders can then access to help with their credit decisioning. So my role within the organization is I'm responsible for analytics and data science. So we do a few things. We kind of look at what's happening out in the industry right now. We'll kind of have conversations with the likes of yourselves, kind of share some of the insights about what's happening in Canada from a debt perspective. And then we also develop some kind of tools and solutions to help lenders with credit decisioning. So things like credit scores are an example of that.
So you really have sort of the pulse on what's happening on credit and everything that's happening in the country. So you're definitely the expert to talk to about this particular topic. So I want to get into the results of Equifax Canada's latest Consumer Trends Report because the findings are concerning. Your research shows that Canadians are really struggling financially, and as a result, delinquencies are continuing to rise. And it seems that it's not just credit card or other unsecured debt that many are struggling with. We're starting to see, unfortunately, a rise in homeowners missing their mortgage payments, and that's especially happening here in Ontario. So I want to focus on this part first, this missed mortgage payments and the struggle that homeowners are facing. What was the result of this from your report?
Yeah, absolutely. And it definitely is a bit of a concern. So, I mean, there is a little bit of good news. So let me start with that first. If we go back to the last couple of years, when we were in the pandemic and there was a lot of cutback in terms of spending and things by consumers, we actually saw missed payments on mortgages falling. So we are coming off the back of quite a low period of missed payments. So that's kind of the good news. As you kind of mentioned, though, the less good news is that we are seeing those missed payments starting to rise. That's happening everywhere in Canada. But as you mentioned, in Ontario in particular, and also a little bit in BC, we're seeing those missed payment levels are really starting to kind of pick up pace in terms of how many consumers are missing more and more payments each month. We're actually back above slightly where we were before the pandemic here in Ontario. And that is a little bit of a concern. And one of the reasons why it's probably a little bit more prevalent in Ontario and maybe BC is because we know those regions have had those really hot housing markets. We saw prices rising. We saw mortgage amounts going up. So when you start to look at what's happening on the economic side with interest rates being high, we're probably seeing it more in those regions because as consumers are coming up to their renewal point on their mortgage, they're going to be experiencing those payment shocks and rises in monthly payments. And that's likely why we're starting to see now some consumers really starting to struggle a little bit and even missing payments on the mortgage themselves.
Well, and you just mentioned there about how mortgages are coming up for renewal, and we know that millions of mortgages are coming up for renewal over the next coming months. And there's been many surveys that show that homeowners are worried about this renewal. They're worried that they're going to be able to even manage their new monthly payment that's going to be changing. And I know Canadians were hoping that interest rates will drop, but Bank of Canada Governor Tiff Macklem was clear at the last announcement that it's really too soon to start talking about any kind of rate cuts. And economists are predicting that we won't see any kind of a rate reduction until at least mid-year. And of course, then the Bank of Canada was again very clear that those days of the low interest rates are pretty much over at this point. So do you have any insight on how mortgage renewals have impacted Canadians in the last year?
Yeah, I mean, as we start to look at what's happening, on average across Canada, post those renewals, we're seeing monthly payments rising by around $457 on average. So that's across Canada as a whole. Now, of course, there's going to be a lot of consumers that are seeing increases above that point and a lot below. So that's the average. Here in Ontario and BC, that's actually closer to $680. So that kind of shows that difference with those regions, and probably one of those reasons why we're seeing missed payments pick up a bit faster in those areas. So, it definitely isn't an insignificant amount. And for many, it's actually way above those levels. There's kind of, if you have a mortgage that's kind of several $100,000, that impact's going to be much kind of greater for you. So it's definitely a bit of a challenging period for you if you are coming up to your mortgage renewal point.
Do you have any advice for homeowners that might be watching today, or even those who might be facing a renewal coming up?
Yeah, I mean, it's difficult because everyone's situation is different. So it's really important, first of all, to make sure you really understand your financial position. Take a look at all of kind of the debts you have, including your mortgage. Start to look at what you can realistically afford to do payment-wise, and that's going to give you some information that's really valuable as you start to then look at mortgage options. And that would be the next piece of advice, which is, shop around, look at the different options, really understand the mechanics of what you're signing up for with your next mortgage to make sure you understand things like repayments, maybe overpayments if you're in a situation to do that. And if you don't feel comfortable figuring all that out by yourselves, there are lots and lots of free organizations out there. There are lots and lots of mortgage advisors out there who specialize in this area and can kind of work through the options with you. For some, it might be, actually looking at extending your term out could be something you could do to get the payments down. Now, of course, that has a knock-on impact because you have to pay more interest overall. So you are paying more in the long run. It could be that there's just different ways of looking at, bi-monthly versus monthly and things like that on your payments. So getting advice is highly recommended, but it's different for everybody.
Absolutely. I totally agree with that. And so with the higher interest rates that many homeowners are feeling, we're strained. We've got a high cost of living now with inflation and things like that. And as people are trying to keep up, Equifax's research shows that many are leaning on credit to get by just with our basic living expenses. Can you speak a little bit more to those findings?
Yeah, definitely. I mean, when we look at total consumer debt overall, it's currently sitting at around $2.45 trillion, which is a huge amount. That does include mortgage debt. So around 3/4 of that is mortgage debt. So the rest of it is then non-mortgage. By non-mortgage, we mean things like credit cards and auto loans, lines of credit, those sorts of things. So when we look at what's happening with non-mortgage debt, we've seen credit card debt in particular rising a couple of years now, but particularly in the last 12 months, it was up close to $16 billion compared to last year. Now, that's not necessarily a bad thing. There are lots of reasons why credit card debt rises. So one of those is actually linked just to population growth. And if you saw some of the, I think Statistics Canada released some numbers for 2023, the Canadian population grew by the fastest it has since 1957 last year. So, we are seeing huge population growth, and that translates into more people needing and using credit, and that pushes credit card debt overall up. So it rising by itself isn't necessarily a bad thing. But when we start to look at average balances on credit cards, that's where we're also seeing rises as well. So individuals are seeing their balances rise month on month. Some of that's going to be linked to inflation. But what we actually are seeing in our numbers is we do believe there are parts of the population that are more reliant on credit now. And so they are using their credit card more and more. And we're seeing payment levels starting to fall as well, which is a bit of an early indicator, warning sign of financial stress when payments on credit cards start to drop. So yes, I mean, mortgage is a concern, but obviously on the non-mortgage side, we are seeing some movements as well, which, we are keeping a close eye on.
Well, you touched on this next part a little bit where, you're seeing trends in sort of different demographics and things like this. So sort of getting more into that, can you talk about the demographics, first of all, who are most indebted?
Yeah, so most indebted tends to be kind of the middle age ranges. So when you kind of look at millennials, those sort of age ranges, and that's really just because typically that's the age where we're the most credit active. We tend to, maybe have had the opportunity to purchase a home. We tend to have auto loans. We tend to have more lines of credit usage. So those age ranges do tend to carry higher average balances in general. And as we start to look a little bit more in terms of payment behaviors and things, and where we are seeing some of those payment behaviors shifting, we are seeing younger consumers, they tend to pay a little bit less on their credit card compared to older individuals. And so we're seeing a bit of movement there, a little bit of financial stress potentially coming through in that group. But we are seeing across the board, just people are paying their credit card in full less. We're seeing the minimum payments rising. So some concerning movements that we're starting to see.
And you mentioned this too, where you're seeing because of those demographics, those sort of middle-aged individuals who have more access to credit. We've got the mortgages and the car loans and things like that. It seems that we're also seeing a big increase in the delinquencies in those age groups. Is that consistent with the report from Equifax?
Yeah, it definitely is. Definitely is. We are seeing growth across the board, but those age ranges we're seeing at a higher rate. Now, part of that might well be because in that group, you do tend to have more homeowners and kind of what we were talking about earlier, with the renewals coming up, as you end up paying more on your mortgage, that also has an impact on your non-mortgage debt as well, because, you have less finances to pay for everything. So, it is expected that we would see delinquencies rising a little bit for that group because of the mortgage side. Now, for those that don't have a mortgage, though, we see missed payments rising as well. And that's probably more linked to just the sustained higher cost of living that we've all been experiencing. Interest rates are higher. So if you do have things like lines of credit with variable rates, interest rates on there, your payments are going up. And again, that has an impact on missed payments. So a few reasons why that group is likely seeing the faster delinquency levels rising. But it is across the board as well. It's not just that group that are finding it quite difficult.
What about regionally across the country? Are certain provinces seeing more delinquencies than others?
Yeah, I think we mentioned it on the mortgage side of things, Ontario and BC. We're seeing that on non-mortgage as well, unfortunately. They are seeing, kind of 35% increases in terms of non-mortgage delinquency levels, in terms of how much they're rising. And again, it's going to be linked to all the factors we talked about. And it's not just the interest rate on your mortgage. There's also rental prices as well. If you don't own your own home and you are renting, we are seeing rental prices have been increasing for some time into Ontario, Quebec, BC, and that's going to be having that impact on how much disposable income or how much ability a consumer has to kind of make their repayments on their credit. So yeah, it's that's why we're seeing, I think, those levels rising.
Absolutely. And of course, with the rise of delinquencies, it's reflective of what we're also seeing on the insolvency front as well. We've seen double-digit increases for the last few months. According to the last statistics from the Office of the Superintendent of Bankruptcy for the 12-month period ending in January of 2024, insolvency filings were up 27.1% across the country. Now, bankruptcies were up in that period of time 7.6%, and consumer proposals were up to 27.1%. But then here in Ontario, it's just slightly higher, with insolvencies have increased 28.8%. And so we're seeing this trend sort of keep moving in that direction where there's more delinquencies, people are struggling even more. And it's difficult to hear about these results that we're hearing from these reports, but it's also important to remember that there are things you can be doing to safeguard your financial well-being. And Rebecca's going to have some great advice for you when Money Matters returns.
This program is brought to you by Ignite TV. Now you're in command. Visit Rogers.com for more details.
After a night out with your friends, not having a plan for a safe ride home can leave you in a bad spot. You could end up riding in a police car, an ambulance, or a hearse. These unplanned modes of transportation can be a costly choice and do not take you home. Your plan could include a designated driver, a taxi, or public transit. Drink responsibly, choose your ride, and have a plan for a safe ride home.
Visit arrivealive.org to find out more.
What kind of show do you want to see on Rogers TV? What interests you? Log on to rogerstv.com, fill out a show proposal, and tell us about your segment idea. We want to know what you want to see. Rogers TV, only on Rogers.
Welcome back to Money Matters with Shannon Jackson. My guest today is Rebecca Oakes, Vice President of Advanced Analytics at Equifax Canada. And we've been talking about Equifax Canada's latest Market Pulse and Consumer Credit Trends and Insights report. And like many surveys, it shows that Canadians, including many here in Ontario, are struggling with affordability. And there's no doubt that these continue to be uncertain economic times. But it's important to know that there are steps you can take to help you cope financially. And that's going to be our focus for the remainder of this show. So first of all, Rebecca, what advice can you share with viewers when it comes to managing their finances, and particularly debt, during these uncertain economic times?
Yeah, I mean, the first thing I always say is be really aware of your financial situation. It's so important to kind of take stock on a regular basis, look at your income, look at your expenditure, look at your commitments that you have from a credit standpoint, or indeed outside of those, and really just kind of review, how are you managing, how do you feel about your current financial position, because everybody is different. What works for one person may not work for another. So really take stock of your current situation. Second thing is then take a deeper look at your household budget. Again, there are organizations out there that can help if you don't know where to start when it comes to budgeting. And maybe take a look and see, are there things that you're spending on which actually maybe you decide you don't need to anymore, or maybe there's kind of discretionary spending that you're making that you can decide to cut back on so that you can focus on, maybe paying down some of the outstanding debts you have and kind of help to clear some of those balances. Other thing which I know a lot of financial advisors recommend is thinking about having an emergency fund, something that you can save in the background. So if there is something that comes up, like a washing machine breaks down, or there's some kind of urgent trip that you need to make, you have some funds available to help. Now, that's not always the easiest to do, to kind of put money aside for emergencies, but that's always a good bit of advice as well. And then, obviously start thinking about, how you kind of work through your current situation. If you're looking right now and you find it difficult to kind of keep making the commitments you have in terms of debt repayment, well, then talking to someone about your options can really help as well. And look at kind of, there often are different things that you can do to kind of help in that situation. Speaking to your lender is always a great way. Often lenders would much rather you call them up and have a conversation if you're struggling to make payments back to them than kind of them having to chase you. So a few things you can do there.
Yeah, I agree with just having a look at where you're spending your money and see if there's ways to cut back, or you may be surprised that you're spending money on things that you haven't used in a long time, like those online subscriptions that we get and things like that. There's always ways to find a few extra dollars. And I like that you mentioned too about reaching out to that professional, because our latest BDO Affordability Index report showed that only 21% of Canadians actually seek out the help of a professional when they're talking about their finances. So it's really important that if you are struggling with any of these questions, or you're not sure where to go, definitely reach out to either a financial advisor or even a licensed insolvency trustee, because you'll at least get some free advice as to where you can go from here. And so managing and paying down debt is going to help free up the funds, and you'll better be able to manage those monthly payments, which then of course leads to a more positive credit score. So Rebecca, can you talk about a credit score, because it seems like it now is a really important time that we want to try to safeguard that. So what information can you give us about our credit score?
Yeah, sure, absolutely. So maybe if I just start with what a credit score really is. So typically it's a number of 300 to 900, and it's used by lenders to help understand the likelihood or the probability of an individual missing payments in the future. So that's what it's designed to do. It's built up using data from your credit file. And it's a statistical model, basically. It's kind of looking at different behaviors and predicting the likelihood of missing a payment. So a low credit score would kind of indicate to a lender you have a slightly higher risk of missing a payment, and a high credit score means you have a lower risk. There are different scores in the market. There isn't just one score that's out there. All of them do a very similar thing in terms of taking into account different combinations of data and making that prediction. And lenders typically will choose the one that helps them the most in their lending decisions. So they are very similar, but they might have slightly different data that's in there. Now, it's worth remembering the credit score is only one data point a lender might use to help with their decisioning. There are other pieces of information they may use as well. But it is important, as you mentioned, to kind of be working to improve your credit score. And a great example of that is, you might have two individuals, say, applying for an auto loan, one with a score of 700, one with a score of 850, both good scores, both likely to get approved by a lender. But actually, the higher score might get a slightly low interest rate that's offered to them as part of their loan versus the other one. So having a higher score can give you better access to products. It can also help you get better rates and kind of the actual offer you get might be more affordable or kind of better because you're seen as lower risk. So definitely worthwhile looking at your credit score and trying to improve it.
That's interesting that you mentioned that it doesn't necessarily come down to whether you're going to get approved for the loan that you're applying for. Because the higher the score, like you mentioned, you're going to get approval, but you might also get that little extra better interest rate than someone else. So that's good information to know. Can you talk a little bit about what factors go into that credit score calculation?
Yeah, sure. So, typically a credit score will look at a few things. Your payment history, so how you have been making payments and the behaviors you've shown, that's a pretty important part. How much debt you're carrying, so your overall balance. It might look at the mix of debt that you've got. It might look at how long you've been using credit for. And it also might look at what your recent activity is. So are you currently applying for lots of credit? Are you opening lots of new trades? It might look at that as well. Primarily, though, it is predicting the likelihood to miss a payment. So if you keep making good payments, that's really going to help you. And then there are lots of other elements that kind of flow into that score as well.
And aside from applying for any kind of a credit or loan, how else can our credit score affect our lives for sort of what we might be applying for?
Well, I think as mentioned earlier, as you're applying for a product, the offer you get, the product you get, that can definitely be impacted by what your score is. If you are missing payments, which is never a great thing for your credit score, obviously that might drop your score and you might get declined. So that isn't an ideal situation to be in as well. So, but mainly it's really going to be about your access and the different types of products that become available to you.
I think as well, there's been instances where some people need to provide their credit report, perhaps if they're applying for a job or even, renting someplace where their landlord has requested it too. And so I think it's important as well that your credit score, it's not necessarily just for when you're applying for these loans. It can affect us in sort of other personal ways as well. So I'm glad that you have that information about how to maintain that good score and what that score actually means and how to translate it. So I appreciate that. So can you tell us the difference then between a credit score and a credit report?
Yeah, sure, absolutely. So the credit report is really where we take all of that information that we're receiving from different lenders and we just collate it into one document that kind of has it all on there. So it will list out things like each individual trade that you have. It'll talk about the balance, the payment behavior when you opened it, versus the credit score, which is then taking that information and it ends up going through a statistical algorithm, really. And it's kind of an equation that takes, if your balance is maybe high or if your utilization is high, maybe that will kind of reduce some of the points that you receive. So the score is really just that number that kind of collates together the probability of you missing a payment, whereas the credit report lists out all of the information that's provided to us at the credit bureau.
We know that sometimes people, they want to be able to check their credit report and their credit score, but they might be reluctant to do so because they think it might have a negative impact. Can you comment on that at all?
Yeah, so we have something in the industry that we call soft and hard inquiries. So a soft inquiry is, say, for example, when you go and you want to check your own credit reports or your credit score via one of the credit bureaus, you're not actually applying for credit, you're just accessing your own data. So that's what we call a soft inquiry, and it is not included in the credit score itself. So it's not used to kind of impact your credit score. A hard inquiry, on the other hand, is when you are actually out there applying for credit. So you're going to a lender, you are going through an application process, and those hard inquiries do appear on your credit file, and they may impact your credit score. So a soft inquiry where you're just going on and checking your own report and your own score, there is no impact to your credit score from that.
Is there a limit to the number of times you can do a soft inquiry on your own report?
Nope, absolutely not. So as much as you'd like to go check it, you're more than welcome to go check it. Yeah, it doesn't make a difference in terms of how often you check it. It will never impact your score.
That's good to know. And so for those who want to check their actual credit report, check their credit score, how can they do that?
So, I mean, for ourselves here at Equifax, you can go on to equifax.ca, and we have a portal that you can sign up to, and you can get free access to your credit report and score. We are one of the two main credit bureaus in Canada, so there is TransUnion as well that also offers that service. And there are some third parties that also do give you access to your credit file. So sometimes your bank may have their own portal where they will help you link through to kind of see your credit file and credit report as well. But yeah, if you just go on our website, it's free, you can sign up and all the information is on there.
And just to go back a little bit, can you give us a little bit more detail about those ranges when it comes to our credit score? You mentioned sort of the low range and the high range. Can you sort of go into a little bit more detail as to sort of what those ranges specifically are?
Yeah, and it's worth noting that lenders don't necessarily look at this as ranges. They will have their own point at which they are willing to approve someone or decline someone. But generally, if you're scoring, 650, 670 or above, that's considered a pretty good credit score. A poor score might be kind of 550 or below, and then you kind of have a fair score somewhere in between. So, as you get up to kind of over 800, that's a really good score. So, again, it's not so much about, is it good or bad? Just keep working to kind of improve it. And it will give you more access to those products and services that lenders have.
That's really good information. I appreciate that. Do you have any final advice for our viewers?
Yeah, I mean, all I would say is, definitely go online, check your credit report. It's really important to make sure everything's accurate on there. And it also gives you a way to check for anything like fraudulent activity. If someone's stealing your identity, you can normally find that on your credit report. So yeah, keep checking your credit file and think about budgeting.
Well, thank you so much for being here and taking the time to share your advice with our viewers. And I also want to thank you, our viewers, for watching. Until next time, I'm Shannon Jackson.
Connect with us by visiting our website or email us at comments@rogerstv.com.